I think what's even more troubling is that counterparty risk awareness moves in cycles in this market. So when FTX happens, shortly afterwards,
Everybody
like the
talks
next
about it.
6 to 12 months, everyone's looking for solutions to get rid of their counterparty risk towards exchanges, and then next bull market comes. You make your 100% there, and suddenly you start to forget. It can actually go south as well. And what we see now, I think, in this cycle for the first time, even if markets are generally moving in a positive direction, and you're making profits, and your biggest worry is probably not counterparty risk. The serious players are now thinking about how to mitigate these risks before it happens again.
Hello and welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital assets industry. I'm your host, Ian Simpson, and if you want to know what banks, securities firms, hedge funds, HFT firms, and others are doing in crypto and how they're doing it, this is the place for you. My guest today is Dominic Lohberger, head of trading at Sygnum Bank, one of the very first crypto banks in Switzerland. Dominic is a veteran of the financial industry, having worked previously at Credit Suisse as well as crypto finance. Dominic, welcome to RULEMATCH Spot On.
Thanks for having me.
Just kind of starting high level, I wondered if we might talk about the market, and particularly the market for institutions in crypto, since that's the focus of the podcast. And it's interesting because people for a few years have been saying, oh, the institutions are coming. I think we know they are here, right? They are already in crypto now, especially even the largest trading firms of the world. They are in the space and doing business. But maybe from your perspective in trading and from your interactions with people in the industry, where do you think these institutions are looking for opportunities in crypto right now?
Yeah, I believe there's not like this one specific area where you just go and you say, okay, that's the holy grail. If I can achieve that, and if I can venture into this kind of part of the business or part of crypto, that's going to be the one. I believe there's a couple of different niches, and obviously depending on your existing background, on your existing business, you're going to be preferring one over the other, right? So let's take, for example, market making, right? You have some of the guys like the flow traders, the RWs of this world that used to be TradFi market makers, still are, and have entered crypto, which is then to some extent very close to what they've already been doing. And there's the custodians, which might be interested in getting all the ETF flows. There's the, we talked about it before. There's all the stablecoin issuers. There's projects popping up left and right on the stablecoin side from the institutional segment. And then there are the more innovative guys like fixed income tokenization. There's definitely a lot of different niches, and I believe it's ultimately a bit of a function of what your existing business is that you're going to find interesting.
So people are following on from what they know already?
Typically, yes. Yeah. I mean, if you have an existing brokerage business, chances are you're going to expand that by just offering crypto on top, right? It's just going to be very close to your FX setup, typically, right?
That's something we talk about sometimes, the similarities between crypto and FX. Maybe we won't get into that too deeply now, but like FX and actually like every market, right? Liquidity is super, super important. And for institutions, it's paramount. Without liquidity, there is no market. There is no game. How do you think about, or what do you see in this kind of, again, fragmented liquidity world in crypto? Yeah,
I think if we look at liquidity, you can probably look at it as a kind of a two-dimensional matrix, or at least that's how I'm imagining it. So on one axis you have the tokens, and then on the other axis you have the venues, right? And then ultimately you end up having the individual liquidity per token per venue, right? And if we look at the token dimension, I think what people tend to underestimate is how concentrated the liquidity is around the top tokens, especially BTC and ETH. So to put this into perspective, BTC has about twice the order book depth of ETH, which has about twice the order book depth of Sol, which has about twice the order book depth of XRP, for example, right? And just to name a few kind of examples, and obviously that might change depending on the minute and the day, but general concept holds true, and that's an exponential function we're talking about. So it's exponentially concentrated around the very, very top tokens. I think this is something one tends to underestimate, and you can throw 50 million worth of Bitcoin at the market in a matter of a few minutes, no issues. But trying to throw 50 million of a token outside the top 10, top 20 at the market, it's just not going to work, or it's going to take you days to weeks, right? So I believe that's something to be fundamentally understood about liquidity. And then in terms of venues, I believe what we've seen and what has definitely helped improving the liquidity is more and more market makers, more and more liquidity providers, the OTC side coming into this market, as we just mentioned before. And I mean, some of them, yes, they have a pass-through business, but others have a risk book in between, and that risk book just adds liquidity, adds absorption potential for some of these flows that do not end up on the exchange ultimately, but get matched and washed away as such. And yeah, I think that's something we've seen over the last couple of years, definitely growing. So in a good state, but definitely still some potential to improve. Yeah.
And some people have said from kind of TradFi side, oh, that's just a totally illiquid market. But as you point out, there is a lot of liquidity. In the top tokens, of course, it's concentrated, but it is a very liquid market. And you can have a MicroStrategy, you can have now the ETF providers out there in the market all the time, buying, selling, and I would say volatility has, at least in the top tokens, has been pretty muted in the last while, right?
Definitely, yes. No, I mean, for the top tokens, that definitely holds true. It's just extremely concentrated.
So let's turn to Sygnum now, and you've been with Sygnum since the very beginning. We were talking just before. I remember August 2019 when Sygnum, as one of the first licensed crypto banks, so-called crypto banks in Switzerland, came online, and you've been there since the beginning. Can you just kind of give us an overview as a bank serving crypto, but having quite a broad offering? What do you do for clients? You're in trading, but there's other things as well, right?
Yes, yeah, for sure. I mean, trading together with custody forms sort of the base layer for everything that we build on top. On the trading side, we're offering crypto spot derivatives. We're offering FX and access to traditional markets as well. And then, as said, together with custodies at the base layer, on top of that, you build products like credit and lending, lending facility for our clients. We have more innovative kind of frontier products like tokenization. And we're also serving the B2B space, and by that I specifically mean bank to bank quite actively. We have products like our crypto compliance services, where we're offering KYT assessments for specific transactions to other banks. So quite a wide range of products, I would say, yeah.
And it started with trading and custody and so on, and those things came after, or was all of that kind of on the roadmap as you started out? Or did you kind of respond to market needs?
Yeah. Some of it was our idea. Some of it was definitely also driven by market need. Just to give you one example, if you look at our API infrastructure, wasn't the first thing we built, but ended up being quite a need in the market, especially when serving B2B clients. And so that was definitely something we built in line with the market rather than out of our own initiative. Yeah.
And you mentioned traditional assets, and so as head of trading, you cover both sides, crypto and TradFi. How does that kind of look in that world? Since in your case, crypto is probably the bigger part of the trading and the offering, right? Kind of the heart of everything that Sygnum does.
Yes, it is. It is definitely the heart of what we do. It's the majority of our business still, but it's interesting that you mentioned that, because if you look back at Sygnum and the way we thought about TradFi in the early days, if you would have asked us 5-6 years ago, we would have felt like traditional access to traditional markets would be kind of diluting our value proposition and would be sort of giving or leaving the impression that we're just another private bank that also offers a bit of crypto on top, which we're definitely not, right? And I think that perception has also shifted over time as we've got to learn that, okay, it's a complementary product. It helps. I mean, clients have also crypto-focused clients have a need to diversify into TradFi instruments with yields rising. We've obviously seen a lot of interest in UST bills, for example. And just ignoring that and being super religious about your stance on crypto, I think, doesn't help. And so we've definitely softened also that approach for sure. Yeah.
And then you mentioned private bank, and of course, I'm not going to put that label on you, but you do have private clients, right?
We do.
Private clients plus institutional. Can you just talk a little bit about what considerations there are on the one hand versus the other? What is complementary, or how that plays in the offering, but then in how you build things and everything that goes on?
Mm-hmm. I mean, if you think about the typical private client, they're not going to onboard with Sygnum because they can buy Bitcoin. They can buy Bitcoin in a million other places, right? That's not the main reason they would onboard. The main reason they would probably onboard, or they do onboard these days, is because we provide a sort of a white glove service. If you're calling us, if you're calling a relationship manager, there's actually someone picking up the phone. There's not a bot there, and you can talk to someone, right? You don't need to open a ticket to get your needs served. And I believe that white glove service is what they're looking for, together with the expertise of being in this market, understanding their kind of background, because a lot of these private clients, they've probably been in crypto for a while. They have maybe had a successful project, and they're now banking their own private funds as well with us. And so having a bank that understands that and can kind of draw the conclusions out of that is important. And so that's the private client side of things. And if you then compare that to the institutional side of the business, where I believe the focus is much more on the competitiveness of the offering. So, okay, I want to integrate via API, then I send a trade. I'm interested in transaction cost analysis. I'm interested in reporting. I would like to know when your maintenance windows are, so I can adjust my setup to yours, etc. So it's a very different perspective. But I think what unites both sides, or where things come together, is ultimately, if you're professional about what you're doing, you will serve both sides well. Right?
So you mentioned some keywords there: transaction cost analysis, reporting. Those are things that, let's be honest, in the crypto market, and for maybe me and you as private clients, we, as you say, don't care about, and yet they really are fundamental to institutions. Hasn't been a focus for a long time, but you've had to build that up, and that is becoming really a requirement now, isn't it?
Definitely, yes. I mean, we have, since the very early days, for example, the topic of best execution has been a very prominent topic on our side. So we are recording about 250 gigabytes of market data. So that's just pure numbers every month in terms of market data, just to be able to kind of reconstruct a smart order routing flow, for example, and be able to kind of prove all of these best execution criteria. So it does come with quite a bit of an overhead, but it's a necessity to be in this business, and I think it's what sets you apart ultimately. Yeah? And based on that, you can then of course build kind of that. So those are the base regulatory requirements, and on top of that, you can build products like TCA, like advanced reporting capabilities, and so on.
Just on the topic of best execution, now a previous guest, I won't mention his name, I think you know who I'm talking about, when asked about that exact topic, basically flat out said it doesn't exist in crypto, or it's very difficult. Maybe you have a different opinion, or is the understanding of best execution fluid enough in the market that it can be true in certain scenarios, or because this also comes up in regulatory conversations going forward, and will be more and more a conversation, right?
Yes. I mean, some of the factors of best execution as a concept involves
a lot of
multitude of different factors, right? From settlement speed, execution speed to price, and so on. And some of these factors, they may be different for crypto. They may not apply at all. And that's fair enough. I think whatever doesn't apply, you can simply not consider. But there are also other factors that do apply. So, for example, getting the best price out of a number of exchanges or a number of counterparties. And I believe what we're trying to do is we're trying to make sense of best execution in a TradFi setup and trying to see where we can apply it in crypto to approximate it as close as possible. Because at the end of the day, the goal of best execution is protecting the clients or the investors' interest. And I believe that you can generally do in crypto, although you may need to tweak it here and there a bit. Yeah,
yeah, and that's an interesting topic or question for me, knowing, a bank is a bank, right? So there are obviously very high criteria, and yet crypto being such a new industry, such a new asset class and market with a unique market structure, when you just think about trading, for instance, and some things have to be built by yourself or put together. Have you had to make any compromises or find ways around to do different things that you would normally have just had out of the box in TradFi, but in crypto, well, it's not there, or you have to do something different?
Yeah, for sure. I'm just thinking of the many examples that we have. But I mean, one that's very close to my heart is the trading setup, right? So it's one thing in a private setup to connect to one exchange. You might want to write a Python script and use a bit of ChatGPT, and you can get that done with little experience in an hour or two, right? But then doing that in an institutional setup where you have a number of different exchanges, they all work differently. They all have very different behaviors. In the early days, in particular, you used to be, there were times where you sent an order to an exchange and you just wouldn't get a response, right? So you didn't know was the order executed or not. So all this edge case handling. I think there's a lot of devil in the detail when you set up a trading desk like that, and maybe a few other considerations that played into these early. I wouldn't say we had to do a lot of compromise, but definitely in these early kind of blueprints that we designed. One factor that plays into that is the fact that crypto, every Swiss bank holds the crypto assets of its clients off balance sheet, meaning it's not able to work with those funds, right? It's very different from a normal bank setup where if you deposit your funds, well, the bank can work with that and extend loans based on that, for example. And we cannot do that, and neither can any of the other banks in Switzerland. And I think that puts some fundamental limitations on the way we operate. So, for example, let's say we want to go for a trading setup where we have 4, 5, 6 exchanges integrated, like we just discussed before. And then I want to do a best execution, smart order routing setup where I just route to whatever exchange is best, quoting the best price. Well, an exchange fundamentally works in a pre-funded setup, meaning I need to hold 5, 6 times my expected client flow pre-funded with the exchange. Where do I take that from if I can't use my client's assets? So I need to fund that out of my own equity, which is just going to be extremely capital intensive and basically kills any business case. So one fundamental consideration in the early days was how do we deal with that exact problem? And the way we went about it is that we are working with market makers or liquidity providers only. And the beauty of that is they basically can extend you a credit line. And from our perspective, it's like outsourcing our balance sheet, right? So we're passing on that responsibility of pre-funding on the exchange to the market makers. Yes, they charge a few basis points on top, and that's fair enough. For us, it's still going to be way cheaper than doing that entire setup ourselves. So there's that capital side of things. And then on the tech side, I mean, yes, you can, as I just alluded to, right, you can integrate one exchange, and that's fairly straightforward. But doing so with multiple exchanges and setting up the algorithms to route your orders is quite a complex undertaking, and not even mentioning the maintenance part of it, which is just ongoing. So we also decided to outsource that and work with an order management system provider that basically does that work for us and serves as an abstraction layer for us.
So that's a lot of pieces of the puzzle to put together. I can imagine it took a long time to kind of think about that. And of course, what people sometimes forget when we talk about institutions in crypto is that most of the infrastructure, the market players came for retail, right? That was the markets at the beginning, and retail exchanges and apps and so on, and that's big and huge, but it's not exactly set up for institutions, for banks, and especially in the setup the way it works in Switzerland. So that capital intensity is somewhat of a barrier. We'll get back to maybe the pre-funded topic when we talk about settlement, but you mentioned the tech and so on. Yeah, Python scripts, WebSocket, some of those things. Not exactly standard stuff from TradFi, right? Is that changing? Is that getting better? Is there more and more fix and technology to actually do it the normal way, or?
Yeah, for sure. I mean, there is more and more fix. I mean, we had the benefit of not starting with the legacy layer of infrastructure, so we were sort of agnostic to the tech setup. Although, of course, if you can, do the same kind of integration across different venues, it's always going to be easier. And so that move towards fix for most of the market makers is actually completed. I would say all the larger ones offer fix connectivity by now. Yeah.
That's what you would expect,
yes.
right? Especially if you are in the position that you're at as a bank offering TradFi trading, crypto trading, you don't really want to have two sets of toolkits and two of this and this and this, right? It's not just capital inefficient, but also operationally inefficient.
Although, I mean, if you are really specialized in crypto, you will most likely have a different setup for your crypto trading than for your TradFi trading, because there's just no TradFi order management. There are a handful out there, but to the level of detail and integration, sophistication that we expect, there's only most of them are crypto specialized providers.
We're talking about Sygnum as a bank, and people have in the market from time to time made the point that there are some other players, namely so-called exchanges, who kind of play bank. Yeah, they at least serving retail clients. Of course, they take funds and then you trade, the pre-funded thing that we talked about. They also hold them, so they're kind of the custodian. Then often, maybe the extreme case was FTX and Alameda were the market makers, so kind of bundling all these things together, making themselves the bank. And then, again, FTX was a bad example of what happens when the bank goes bust. Does that irritate somebody who is a bank and who does things right? And how do you deal with that when players are operating this way?
Yeah, I always think about this quote from Michael Higgins from Hidden Road, who put it nicely. He said, we need to advocate for this separation of church and state, which is exactly, I think, what you're talking about. I mean, an exchange is not fundamentally set up as a custodian, and yes, that is troubling, and we've seen the implications of that in the past, right? And I think what's even more troubling is that counterparty risk awareness moves in cycles in this market. So when FTX happens, shortly afterwards,
everybody
like the next 6
to
12 months, everyone's looking for solutions to get rid of their counterparty risk towards exchanges, and then next bull market comes. You make your 100% there, and suddenly you start to forget. It can actually go south as well. And what we see now, I think, in this cycle for the first time, even if markets are generally moving in a positive direction, and you're making profits, and your biggest worry is probably not counterparty risk. The serious players are now thinking about how to mitigate these risks before it happens again, right? And that's, for example, where a lot of these off-exchange custody solutions come in that we see now in the market. We have some that are more crypto-oriented. There's other solutions. There's a wide range of different solutions that are popping up that allow you to hold your assets off exchange and then still trade basically on the exchange, which then ends up being exactly the separation that we just talked about, right?
And is that kind of shift, is that driven by the clients, by the bigger institutions, by the exchanges themselves, as they see, well, we have to change our model? Who is driving that those kinds of setups?
Yeah, that's a good question. I mean, you would intuitively think that the exchanges don't necessarily have an interest to facilitate a solution where clients hold their assets off exchange, right? But we see actually quite the opposite is the case, that especially some of the larger exchanges, they have been confronted with this this worry from their clients for such a long time now, as latest since FTX, that they also had to think about solutions. And ultimately, if you can protect your trading volume, that's probably going to be the most important part for an exchange. And if you can facilitate that and give your clients what they're looking for, it ends up being a profitable case nevertheless, even though you may lose some assets under custody, right? So the push is not just from the client side. It's obviously also from the client side, but it's surprisingly also from the exchanges to find solutions. Yeah.
And that's, again, I guess you could say, kind of an example where a market went in a certain direction and then realized, oh, well, maybe institutions or regulation requires or clients require something different, and now we have to find a solution. It's, in some ways, it's a little bit like, how do you say in German, gebastelt, or not, I hesitate to use that term, but a way to do it somehow better, different, and so on and so forth. But it works, right?
Yeah, I think it's the natural evolution to address the kind of shortcomings of the current setup, which have worked until now, but with an institutional dominated client base, it's not going to work anymore. Yeah.
And do you think the market structure as a whole will develop from retail exchanges to OTC desks? I mean, how do you see the entire market, players, venues developing?
I mean, institutions are for sure going to play an increasingly important role. But I mean, if we look at where this market is driven by and what, you know, where the culture of the market comes from, it's the retail side of things, right? And so I believe both will be able to coexist, and the retail side will probably be more oriented around the meme coins and all of these topics, whereas the institutional side will focus on the top 10 tokens, which again may add on top of this liquidity concentration in the top 10. And I believe each one will sort of have their part there, yeah, for sure.
We talked about the pre-funding topic, which is how the market has worked and has been an issue, which basically means that in crypto up until today, there hasn't been any post-trade settlement, or if there has been, it's been kind of unstandardized and so on. How is that developing, or how is that progressing? Will we see a move towards more institutional TradFi-like post-trade settlement?
Yeah, I believe it's already happening. It may not be very obvious to kind of the retail side of the business, but it's very much happening
to them.
Exactly. Yeah. It's very much happening on the institutional side, and it's there since years already. I mean, I mentioned our challenges that we faced in the beginning. We have addressed them exactly through post-trade settlement limits. So being able to trade now and then settle later. We definitely see that coming up more and more. And it's also, we see PBs coming up, prime brokers coming up more and more. So a lot of the concepts that have proven to work in TradFi are actually being replicated. And that's good, right? We don't need to do things differently if they have worked well.
And how does that work, you know, in a multi-venue setup with settlement, post-trade settlement? That seems complicated.
Yeah, indeed. I mean, the trading is probably 5 to 10% of the work that you do in and around a trade, and the rest is post-trade, and the settlement and the coordination and sending funds on the blockchain. And then on the fiat side, obviously, sending US dollars is a challenge in itself at the moment. So sending US dollars in a crypto context through the market is just, has gotten more and more difficult. I think we have now had 5.5 years to optimize that setup, and it has taken us also quite a lot of effort to streamline the coordination of different settlement windows at different times during the day with different counterparties, different setups, different risk limits, and there's tons of different factors that play into that, has led to us building really a custom solution for this settlement layer. But the way we see Sygnum's role in this is actually a bit different. So we've launched a settlement network. It's called Sygnum Connect. It's a 24/7 settlement network where you can send fiat and crypto to any other counterparty within Sygnum instantaneously. Right. So crypto doesn't go through the blockchain. It's essentially just an entry in our ledger, -1 on that side, +1 on the other side. And it's quite straightforward. Same thing on the fiat side. And the benefit is, of course, if you have two onboarded Sygnum entities, they don't need to go through correspondent banking rails. They can do that 24/7. So if they trade on a Saturday and need to settle immediately, they can do so right away, independent of which time zone they're in. And yeah, that's something that we see being a puzzle piece, and that was especially also missed during the last years in crypto.
And for kind of more active trading companies, does that settlement also include netting across venues and so on?
Yes, I mean, one of the functionalities we're developing as part of Sygnum Connect is not just a simple transfer of one asset, but the ability to request a settlement batch with the counterparty. So say you've been trading the whole day, you're trading on post-trade settlement limits. And so you've now bought a net amount of 10 Bitcoin and you owe them $500K US dollars, for example. So then what you may want to do is actually the equivalent of an atomic swap. So I reserve the funds on my side, you reserve the funds on your side. And if we both have our funds with Sygnum, I can just trigger them and swap them basically. And you can do that with more complex settlement batches, which then should serve exactly the need of, for example, us ourselves. So this is also built with our own settlement model in mind, that we can leverage this and settle with our counterparties more efficiently in-house.
And that's just on the crypto side, not on the TradFi trading setup.
That's just on the crypto side, although we are looking into whether we can transfer also traditional securities through that settlement network. Is a bit more challenging. You have different regulatory requirements that apply to owning specific securities. So not everyone can buy every traditional security. So that makes it a bit more challenging. So you need a rule set on top. You need certain certain checks in place. But generally, yes, that's one idea. And you can imagine in the end game, if you can send traditional assets, crypto, fiat, through one network instantaneously 24/7, you really have built a liquidity management platform.
So that's a lot of piping, a lot of plumbing to put together. Obviously, sounds in some things there sound a little bit like what a prime broker would do. How, if I can just ask generally, how does that work together or connect to what a prime broker might do? And does Sygnum have some thoughts about how to develop that kind of a business?
I mean, yes, in some areas it is similar. In others, it is not at all. So, for example, we're not providing access to exchanges directly. You're always facing Sygnum when you trade with Sygnum. So we don't have like a DMA type of model that you might get through a PB. We don't have... we're not, as such, extending credit lines in crypto to our clients. There's a few limitations there. But yeah, in other areas, definitely. I mean, a PB ultimately is an abstraction layer of the complex trading and settlement setup that you have if you're an institutional player. And yes, to some extent, we're definitely also playing that role, yes.
And perhaps also, with the possibility to do more in the future, depending on how things develop.
Possibly, yes. Yeah.
Then we come to the regulatory topic, and we cannot avoid it since we are in crypto.
Yes.
Has been a topic for quite some time. Again, it's a little bit like people said, the institutions are coming, and now the institutions are here. Regulation is coming, or we need regulation. Of course, in Switzerland, we've had some pretty clear rules for quite some time, but now the big thing, of course, is MiCAR, Markets and Crypto Assets Regulation from the European Union. Just generally, broadly, how is Sygnum, how are you thinking about MiCAR?
Yeah, I mean, for us, it's a very active and very recent topic, of course. I mean, we always knew we would be jumping on that train when it would leave the station, and we want to be in the front wagon, and that's what we're doing at the moment. So we have a local license in Liechtenstein, which will be converted to a MiCAR compliant one in due time now, and that will allow us then to serve the European market out of our Liechtenstein entity. while keeping kind of the Swiss setup as is, right? Yeah, definitely. So now it's an important topic for us. We've been been following it for quite a while. Yeah.
And so then you have two entities. You also have some other in Singapore entities. So you are international already. How does this all work with your operations? And there's a couple of sticky points in MiCAR that people are looking at and are still a bit puzzled about. But generally, how will you serve the European market?
So the European market will be served out of the Liechtenstein, which is a European Economic Area domiciled entity. But then we have our existing setup, which is the dual headquarter in Switzerland, where we are a bank, and in Singapore, where we have the major payments institution license. So that will remain as is. We have a setup or a license in Abu Dhabi and in Luxembourg as well. That just helps arranging deals for the Swiss banks. We're looking at Hong Kong as well, which is also a topic to expand in the Asian market. But overall, I mean, the MiCAR or the European entity is just going to be yet another puzzle piece that for us it was obvious we would sort of tackle once relevant. Yeah.
And then operationally, infrastructure in one place and service in the other, or that's a complicated.
It's a good question. So we have obviously a booking center in Switzerland. We have one in Singapore. The other entities so far, they serve more as arrangers, or sales outpost, if you will. We will have a booking center in the EU as well under our Liechtenstein entity. But of course, some of the functions will be outsourced on a group level to the Swiss entity, where there's just most of the operations taking place, and I believe, I mean, we will be able to leverage a lot of what we have already set up as a bank for MiCAR, right? We are already subject to very tight regulation, and so a lot of what MiCAR foresees is already implicitly given for us.
One thing that is the sticking point, and we talked at the very beginning about liquidity, it seems like from what the rules say today, or what they seem to indicate, that liquidity for trades within the EU has to be sourced from within the EU. Is that your understanding of things, or have you explored that topic yet?
Yeah, I guess you're referring to the ESMA opinion on broker models that was published earlier this year. Yes, I mean, what we believe, what it ultimately boils down to is, if you're operating out of a MiCAR or MiCAR compliant entity, you want to make sure that whoever you're trading with fulfills the same regulatory requirements, right, or meets the same standards at the very least. Having that Swiss bank, which does do that, probably helps us to also then do certain functions group internal, as I just mentioned, including the trading. So we believe that we can work with our existing setup. But as you say, I mean,
not 100%
a lot of the things, and especially the operational models, are being discussed as we speak. Right, not everything is 100%
even as we move towards the end of the year.
Yes,
now 2024. The other thing that's big in MiCAR, of course, is stablecoins. Really putting quite some limits on non-euro denominated stablecoins. There are stablecoins licensed under MiCAR and more kind of popping up, as you said, like mushrooms after the rain. But of course, stablecoins are a big part of the trading volume in crypto. How are you looking at the stablecoins for your European operations, but then also what side effects, shall we say, might the MiCAR regulations have for operations otherwise?
Yeah, I mean, stablecoins are very important for us, possibly even more so than for other businesses, because we tend to be a gateway in and out of crypto, offering both fiat accounts and crypto, obviously. So for us, it's an important part of our trading volume and our business in general. And I believe, as you said, I mean, I feel there are more and more mushrooms popping up at the moment. A lot of institutions are kind of have seen what Circle and Tether did and the numbers they were pulling, and are just simply trying to also jump on that train, and understandably so. But I believe if we fractionalize the stablecoin market too much, it's not going to benefit anyone, because at the end of the day, what am I going to do with $100 stablecoins? I need probably my 2 or 3 that may differ slightly in value proposition and in setup, but ultimately I would rather have concentrated liquidity around a handful of them. And so I believe a similar thing will be then noticeable in the EU, where I expect that a handful of them will be MiCAR compliant. Those we have our view on, and we will probably look at and closely follow and try to offer. But it's also clear for us that we can't follow every single project there. So yeah.
But still sticking to the ones who either have the biggest regulatory stamp of approval or the biggest volume.
Yes,
I suppose.
Yes, for sure. And also the best operational setup in terms of, for example, minting and burning a stable coin. I think that's what makes a stable coin. It's one of the things that makes it unique in the way you trade it, is that you can mint and burn with the issuer directly, typically. So that setup is also not to be underestimated. Yeah.
Just talk quickly about Singapore, if you can. There is kind of a different world, far away from MiCA, but also some regulatory challenges or unique points, right?
Yes. Yeah, I mean, what we're seeing in Singapore, for example, is that MAS has mandated 90% of all crypto assets to be held in cold storage, which is an interesting concept and definitely a challenging one to implement, especially if you have a very transaction-oriented business where you may turn over more than 10% of your volume on a regular basis. So yeah, there are definitely challenges there as well. However, we've been present in the market. We've gone through a couple of phases or a couple of iterations with the regulator there as well, and I'm quite confident that also these new regulations we will address. And as you say, typically, a proposal comes out. We've seen that with FINMA and stablecoins as well. There's an initial reaction to it, and then we need to see how it develops, right? So sometimes you also need to, just take a cautious step back and just observe, excited, right? Yeah. Not get too overwhelmed and too much into it. Yes, yeah. But definitely following it closely. Again, it's our second headquarter. It's very close to our heart, and we're there, and we will be there.
Yeah. As we move towards the end, we have one question that we ask all of our guests. Maybe you have seen from previous episodes, and that is quite simply, if there is something out there in crypto, whether at Sygnum or more generally in the market, that not many people have noticed yet or are talking about, that we should keep our eye on, some small tip for our listeners and viewers. Is there anything you can share with us?
I guess we talked on a lot of the points from the professional side, but now from a private perspective, something that I've been reading up on lately is this whole topic of quantum resistant cryptography in the context of crypto. It's a completely different topic, but I believe it's very interesting. We've seen in the early days of crypto a couple of projects coming up with ideas, and now this topic is becoming more and more relevant. There are several top tech companies that are advancing, although we might still be a decade away from a working quantum computer. Some say that you'll know there's one around when Satoshi's wallet gets touched. But I believe it's you can never be too early and think about what the next big move will be, and that I think is an interesting one. But that is really more just me talking out of what I'm personally interested reading up on.
Okay, I mean, it's a topic that does affect quite a few people. Yes. I happen to know that Thomas Moser at the Swiss National Bank is also following that topic quite closely, since it potentially has implications for a lot of things around the world.
Fundamentally change the way we transact, and specifically also the blockchain works.
Yeah, very interesting. Dominic Lohberger, thank you very much for joining RULEMATCH Spot On. Very interesting. There might be more things to talk about coming up very soon, so look forward to that. And thanks again.
Thank you for having me.